Hello everyone, how's it going? If you're looking to buy Palantir stock, then please keep watching because we're going to look at the company's recent news, how's the market treating it, and what are the technicals telling us. We're also going to try to come up with a trading approach given the current circumstances at the end of the video, so definitely stay tuned. As the market remains very volatile at the moment, we should always be mindful of which positions we pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Palantir has been approaching the $20 level as its price edges ever close to the critical psychological level. The company has massively betted on the artificial intelligence narrative recently, and so far it has really paid off. The market accepts this as an actual vector by which there will be an increase of demand in the subsector. Generative and large language models have been very, have been very popular over the past few months. And it has been one of the first times when the public realizes the potential of artificial intelligence. These large models may likely require the analysis of an ever-growing quantity of data, a domain in which Palantir excels at, who also believes that Palantir may be able to develop its own models thanks to the data it has, and that it can generate more revenue streams along with the private and public domain partners that it has. After all, one of the key advantages of Palantir over many of its tech rivals is its relationships with large entities who have very deep pockets and almost an unlimited quantity of resources as far as the company is concerned. There might be one additional reason why Palantir is having a great time as of now, and that may have something to do with the state of the world we live in. It's quite a funny one. It has simultaneously a lot of conflicts, as well as the potential of seeing some of them reaching an end, which may alleviate some pressure on the commodities prices, the inflation, the interest rates, as well as the stock pricing. Those aspects all contribute to a better outlook to Palantir overall. Now, with that being said, let's take a look at the technicals of the stock. The trading volume of Palantir recently reached around 75 million shares, compared to the average volume of 63 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $20.24. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity can also mean that the demand is limited. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large as well. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is currently around $43 billion versus an enterprise value of $15 billion. As we compare the current price to the historical price fluctuations, the stock is 36% higher than the 1-month low, 44% higher than the 3-month low, and 238% higher than the 52 weeks low. On the options market, which often gives us a hint about the market sentiment where the stock price might go next, the implied volatility is 55% versus a historical volatility of 75%. The put-call volume ratio is currently 45%. It is normal for most stocks to also tend to have a higher put option volume than what they truly deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 328,000 contracts a day versus the 30-day average of 302,000. Regarding the open interest, the most recent volume of open interest is around 3 million contracts versus the 30-day average of 2.8 million contracts. Regarding the shareholder structure, institutional owners have about 36% of the shares in terms of the float. The biggest shareholders include Vanguard, Renaissance, and BlackRock. Now, the total share of institutional ownership has barely changed since its very beginning, since the inception when the company went IPO. With that being said, it doesn't really mean that the market doesn't really trust Palantir. It's definitely one of the more volatile and more active stocks and more talked about stocks in the NASDAQ. And it's also, in my opinion, one of those symptomatic phenomenons from which we can see whether the tides are turning. Usually, it's always good to see some institutional participation when holding a stock long-term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 20 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retail traders. The current short interest is around 8% of the total float, 60% of which come from the dark pools. Usually, if the short interest is about 15% of the total volume, and a significant portion of the short volume comes out of the dark pools, it may suggest that there are institutional positions taken to short the stock, and that there would be potentials. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. My recommendation for Palantir is to make sure that you have an existing position and then to start buying it over the next 24 months, since the company may be entering into another cycle or another phase of its development after the initial adoption phase and the trial of errors. An entry now can be recommended, assuming that the bulk part of the allocation is committed slowly over time. I would recommend to commit between 3 to 5% of your portfolio in Palantir and split the allocation in batches of 10 to 20% at a time over the next 24 months so that you can purchase more in retracements.